Welcome to Clear Picture Financial with Jason Noble. I'm your consumer advocate, Jackie Selby. Hope you're having a wonderful day. Jason, how are you?
Doing wonderful. Thank you, Jackie.
Great to see you. Great to see you. Now, you can find Jason right here in Charleston, the Holy City. You can learn more about him and his team at clearpicturefinancial.com. Now, if you don't know, Jason is a fiduciary and he holds his FINRA Series 66 securities registration. He is a certified financial planner. This is important. Retirement income certified professional. And he has nearly 2 decades of experience helping you navigate through retirement. But most recently, Advisor Hub published their top 100 solo advisors to watch in 2023. And this is super impressive. And Jason made 5th overall of 100 and the only one in the top 100 list in South Carolina. So each week you have the opportunity to get on Jason's schedule, meet with him and the team at Prime Capital Investment Advisors. And these meetings are at no cost. And Jason, that's very generous of you to hold these spots open because you are 5th overall in the country. But it's really great to be able to get on the schedule and meet with you at no cost. So welcome, welcome, welcome. Here we go with today's show. And this is really cool because we're going to talk Buffett. You're cool with that, huh?
Yeah, I think it would be a lot because a lot of words of wisdom, and he has rules for investing that he really swears by, and he's done quite well by over the years, right?
Oh my gosh, the guy's 94 years old.
Yeah. So I think we're going to go into some of his words of wisdom and see how these lessons could be really applied towards retirement planning.
Great, let's do it. There's a lot to unpack here. So how, let's just go. Psychologically Prepared by Warren Buffett.
You've got to be prepared when you buy a stock to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding it. If you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others.
It's really true. So you have to be really comfortable with your risk tolerance. Is that what he means?
Well, not only like just risk tolerance, but also having that like positive money mindset when you go into investing. And there is a lot to unpack with what he's saying there. One of the things that is when it comes to investing is sometimes you get the herd mentality, which is what he was talking about, is like other people saying what they think that you should be doing with that investment. Or when you're seeing an investment go down or go up, right, you start to think, okay, well then like I'm doing the right thing or this is the wrong thing. Where having that positive money mindset is really, it's investing is not really for the short term. And it's not the way to go. And when you're planning for retirement and investing for the future, it's about the long term. So mindset and being psychologically prepared is very important to the overall success for folks.
Should we hear his famous quote? What he always says? Here we go.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Well, that's one of his famous quotes anyway. Do you find that people are a little nervous? They have fear as investors because they don't have the knowledge. Is that true?
Well, how do people learn about investing? Right. And it could be taught from their parents or it could be taught from the social circles or someone through work is what I hear a lot about. I was talking to someone the other day and I was like, so how do you go about making your investment choices? And they're like, well, my son does it. Well, the son's a plumber.
Oh,
and so, okay, so that just goes to show in today's age, anyone could be an investor. Anyone could invest. But when she sent me over the statements, I was not looking at a statement that I was expecting to see from a 72-year-old.
Too much risk?
It was extremely too much. It was more in line with the risk score of what I expect to see from him, from the son.
Who's probably in his 40s or something.
And he's going about investing this money in the way that he would invest his own money. And it's not taking into account what kind of volatility that could bring about to his mom's portfolio. So
wow,
more to come on that. But where I think people get caught up in the short term is where they they got to have a bucket of their money for short-term goals in retirement planning, and then another bucket of their money for long-term goals. But if they have all their money in just one bucket, not knowing how they all work together, that's when they start having knee-jerk, emotional, fear-driven reactions rather than having logical steps in place. Because now what I'm talking about is they have a plan, an income distribution plan, a strategy of their overall investments. That's how this works.
And it seems to me, Jason, that sometimes, I mean, gosh, that lady was 72 years old or something that you mentioned, and that's really a crazy time to still have money so active. I guess she just didn't have a plan, and that's what you're for.
Well, that's what we're developing as we speak, and it'll be interesting to see how that plays out, because she may not want to, quote unquote, fire her advisor, her son, that's a plumber. Okay, I mean, I hope if they're listening, I hope he doesn't feel like I'm second guessing his abilities. It's just, though, if someone called me right now saying, hey, I'd like you to come out to my house and look at my pipes because I'm having a plumbing issue, I'd be like, you got the wrong number, right? I mean, that's not my forte. That's not what I dedicated my life and career towards. So here is his son probably trying to just help his mom out because she asked him for the help.
Yeah.
But I think, if I could give him any advice or guidance is, why did you feel like you should take on that burden, that responsibility for something that is this important as your mom's finances? Why wouldn't you go and interview an advisor with your mom?
There you go.
To find a qualified person to help them navigate. But yeah, I think you were alluding to one of Warren Buffett's famous rules.
Oh, here we go. You'd like to hear that?
Yes.
Here we are.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
And that's that group of them. Tell me about why that's an important part of his statement.
There's a lot to unpack there as well.
Okay.
So the group of them is buying a basket of investments. So making sure that you have a diversified portfolio. You're not just buying putting all your money in one basket or in one stock. Okay. So when you do that, you carry on a ton of risk by doing so. But having a basket of investments, a number of stocks, a number of bonds to diversify the portfolio is what he's alluding to on that part. But the other part is rule number one, don't lose money. Rule number two, don't forget number one.
That's right.
So he talks about the psychology of money. You got to be okay with that stock going down 50% when you buy a stock. But then he's like, hey, rule number one, don't lose money, right? So how do I unpack that for everyone that's listening or watching right now? What he's going into is when you're buying an undervalued stock, so stock should be trading at a higher price. Let's say the stock should be trading around $100 based off its fundamentals.
Okay.
But it's trading at $80 a share.
Okay.
Do you see how that's undervalued based
Yes.
off of the analysis? Okay,
Yeah.
in this example. Well, if you buy it at 80 and it goes down to 40, when it's trading at 100, let's say it goes down to let's say 70 on a stock price, but the fundamentals are still there, you just keep on holding. Maybe you can buy more. You dollar cost average into the position, and then what it would say is eventually the market will become where it's trading at the value that it should be. The inversion could happen. People get really caught up on these stocks and they buy a stock that's way overvalued. It's trading at 150 when it should be trading at 100.
Right.
Right? That's not a position that Warren would go into because he is a value-based, fundamental-based investor. And so that's a stock that he would stay away from.
Agreed. And maybe a stock like Disney, for example, I think I heard you talking about this, that has lost a whole lot of value because the company changed their values. Is that kind of part of it?
Well, So that now you're talking about like philosophical values or social values.
Right. And then they lost some of their value.
Yes, and maybe those changes. No, I'm talking about the fundamentals.
Okay.
Price to earnings, price to sales, price
Gotcha.
to books. I'm talking about the fundamental analysis.
Gotcha.
And the valuation of how you determine what the intrinsic value of that stock really is or what that bond really is. That's what I'm referring to.
Good.
Yeah, and not to bring up any stock in particular for those that are listening.
Okay.
It's like I'm not telling you to go out there and do any action with Disney stock.
No,
okay. No, that was just a question that Jackie had from a prior conversation. I'm glad that you gave me an opportunity to clear that up.
Yes, thank you very much for clearing it up. And here's another quote. This is the Buffett omission, not commission quote.
The biggest mistakes I've made by far are mistakes of omission and not commission. It's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. Those are the big, big mistakes.
Well, he is something else, isn't he? I guess you say anything when you're 94.
Yeah, I mean, well, he has a good way of phrasing things, you know, and just given the financial literacy component and how continuing your financial education is really the best way to not make those mistakes. I can imagine many folks listening right now can relate to that. Now, if you don't exactly know like what you can do, you'll surely lose money over time. That's for sure. But there's an easy way to prevent this from happening.
Yeah.
And it starts and ends with enlisting the help of a professional that explores exactly what your options are. And that's a big component of the work that I do, is just going into here are the pros and cons of these different investment approaches and strategies. How do we work together to build out that approach and that strategy that's complementing what your financial plan is looking for? So here at Prime Capital Investment Advisors, we have core strategies and we have satellite approaches. The satellite approaches come into the core to help complement and maybe even go into what we look at risk and return parameters. Like for instance, if we inject a satellite approach into to a core strategy, what we're looking at doing is seeing how can we maintain the risk or lower the risk, but also either improve the return expectations or maintain. So if we maintain the same level of risk and we have no additional return expectation, it's not worth adding in. We don't do it. But if it maintains the same level of risk but improves the return expectation, then that's a healthy consideration.
Okay.
Another consideration is the returns stay the same, but the risk goes down.
There you go.
If we could do those things by adding a satellite approach into the core component, then that's what I'm working with my clients and navigating them and helping them understand why we're doing this. So when we build out that strategy, it's in coordination and complementing our overall investment philosophy. It's coordinating with the risk tolerance and the risk capacity of the financial plan.